Hi, everyone. So we'll get started for today. Our lecture today will go through the exchange rate and balance of payments. So that's going to be our focus today. And then I'm going to go through some investing strategies also that are connected to this course. So go through some of the how you can apply this content to investing. So I will go through that later in the lecture today. We'll get started on some of the outcomes. So the outcomes for today: the exchange rate and balance payments, foreign exchange markets, exchange rate fluctuations, exchange rate policy, and financing international trade. And also a lot of that correlates to successful investing. So the first question I'll ask is, what can we use in this course so far for investing? So like what types of theories would be useful for investing so far in this course?
I don't know the specific theory, but if you look at what the interest rates are, you know that you potentially want to put in money as long as you're not borrowing when the interest rate is high, because you know when the interest rate goes down, that's better for the stock market. So then you'll start making money at that point.
Excellent. Yeah, that's great, Ashley. A great point. Any other pieces of knowledge from this course that would be effective in terms of investing?
I was thinking if there is a long-term equilibrium for demand and supply, and if it is leftward or rightward, depending on the dynamic of those two, we can also look how we can invest. Because if we know that our current growth is leftward, we can invest knowing that it will be a high payout through the stock market and investing, and rightward it will balance out to the middle again. So it's not the best time for investing. So stuff like that.
That's great, Alexandra. Excellent. Yeah, all great points. And we'll go through a lot more today. We're gonna do some exchange rate work here today, and then we'll go into some more strategies. But great points, Ashley and Alexandra. Does anyone else have any other points for what we can use in this course so far for investing?
I was just going to say like foreign exchange. So like if their economy is doing well, then you can like invest in their stuff.
Yes, exactly. That's a great strategy, Olivia. Excellent. So great input for that. That was great. So let's get started on international trade here. So this is under, so if you want to access it, it's under March 9th materials. So this is all accessible under March 9th materials and in our Financial Online. So let's get started on this here. So international trade. So patterns of international trade. So global trade today is enormous. World trade volume today is roughly 40 times what it was in the 1950s. So about 4,100% growth from 1950 to 2020. So this has been very beneficial for the world. It was so like around 1950, that was right after World War II. And the amount of conflict in the world would have restricted trade. And then as the world has gone on from 1950 to present, we have had improvements in trade through trade organizations and agreements. Also, the internet was a big thing. So like the internet creating e-commerce opportunities. So a lot of that has improved our trading, and e-commerce has made trade improve across the world. So e-commerce has really done a good job in terms of, so e-commerce has been very beneficial in terms of opening up trade worldwide and removing trade barriers. So that really accelerated the increase in trade around the 1990s to present. So you see how steep the curve was in the 1990s. It's like in the 90s, trade through e-commerce was accelerating. So yeah, that was a very big benefit. And then you see that the slope of international trade here, it was accelerating more than it did here, a lot to do with the internet. And so the internet accelerated international trade through e-commerce. So yeah, there's a lot of benefit to that, and e-commerce has removed a lot of trade barriers for economies. So yeah, these graphs show trades picking up steeply since the establishment of the World Trade Organization in 1995. So that was one of the reasons why it went steeply upward, because the WTO, the World Trade Organization, was established in 95. And then as of 2020, world trade volume and value have expanded 4% to 5% respectively on average since 1995, when the WTO was first established. And Canada is one of the world's great trading nations in relative terms. So in 2018, for example, Canada exported about 700 billion worth of goods and services and imported 753 billion. So here, they had a trade deficit in 2018 because imports were greater than exports. So if imports are greater than exports, net exports are negative. And this would shrink the economy. So net exports were negative in 2018. In Canada, usually net exports are negative for the most part. So that's a common occurrence in Canada. Our net exports are usually negative. And I'll ask the class why. So I'll ask that in the chat. Why are our net exports usually negative?
Because our status in Canada economically is much higher than in other countries, so it's less lucrative for other countries to export from Canada because it's more expensive. So it technically is better for Canada to take a lot of stuff, but not a lot of stuff will be taken from Canada because of the higher prices and higher economy.
Yeah, that's a great answer, Alexandra. Yeah, that's exactly what that's the best answer for it. That's great. Yeah, they just don't have enough money to buy from us, and our currency is so much more valuable than most currencies around the world, so we just buy from other people. So a lot of items are manufactured in China. That's other great answer, Ashley. Yes, so we've mostly outsourced our manufacturing to other countries. We're primarily a service economy here, so we need to get things made in other countries. So yeah, great answers on that. That was great. So the US is Canada's largest trading partner. And Canada sells over twice as much to the United States as it does to other countries. Combined, it buys approximately all of its imports from that country. So that here, so it buys most of its imports. Most of Canada's imports come from US, but but many come from China and India and other developing nations. So it's usually developing nations that we get our imports from. Yeah. So that was right here. I just had to correct that there. Put this in the chat here. So patterns of international trade. So China leads the world in exports, has the largest share of world exports, and that's followed by US and Germany. Canada comes in 12th. So China is producing, so basically based on this graph, China is producing the most manufacturing worldwide in terms of it's China in this case is producing the most manufacturing worldwide and trading it to countries like Canada, US, and other developed nations. So really what happens is the developing / underdeveloped nations manufacture our products, export those products to developed nations. And that's usually how the cycle works. The developing / underdeveloped nations manufacture our products and export those products to developed nations. So we really rely on underdeveloped and developing nations to make our products. And that's really what happens in our economy. But what we usually do is developed nations like us, we are primarily service economies. And we create high-tech manufacturing. So we primarily export high-tech manufacturing to other countries and import low-tech manufacturing from developing and underdeveloped nations. So like developing, so China, like places like China, India, developing, underdeveloped nations produce low-tech manufacturing. And we buy from these nations, we buy low-tech manufactured products from these nations. So that's usually what happens. So I'll ask a question. What type of, what do we mean by low-tech manufactured products? So I'll try. Didier, do you want to try? What do we mean by low-tech manufactured products?
Is it products that don't need like superior technology to be made or something?
Yes, exactly. Yeah.
Right.
So yeah, anything that doesn't require any superior technology. So what would require, like what would not require superior technology?
Probably manufacture. Oh, sorry.
I was gonna say like clothes. Maybe.
Yes, clothes are a good one. Yeah, that's a big one. Yeah, good job, Didier. And what were you gonna say, Alexandra?
I was gonna compare like items like clothing, manufacturing of plastics and stuff like that versus the medical industry that requires high tech and cannot be produced in developing countries. So it will require more of technology.
Yeah, great examples. Is great. Yeah, so high tech manufactured products might be like pharmaceuticals. So with all of you in terms of your biotech knowledge and your skill set in that area, there's a real need for manufacturing of those types of products in Canada and the United States. So there's a real demand for your skill set here because it's a high tech manufactured product. So that's a good thing that is the case here because your skill set has a high demand. So pharmaceuticals, medical products, like anything high tech, like yeah. So maybe so medical machines, etc. So biotech. So yeah, so your skill set would definitely be needed here for manufacturing of high tech. So that's a very good benefit of all of your programs here. So I'll put this in the chat here. So then the eighth largest export nations account for about 0.5% of world exports. So these account for about half of the world's exports. And what drives international trade? So I'll try, does Hannah want to answer that? What drives international trade?
Maybe just like needs or wants, like especially if we think about Canada, I know we import a lot of stuff based on wants, like clothing or like random household items kind of things.
Yes, yeah, that's a great point. Yeah, wants. Yeah, wants are a big thing because yeah, exactly. So clothing's a big one, and a lot of other things that we want from other nations. That's great, Hannah. And then yeah, so wants are a big one, and another reason is comparative advantage. So if a country has a lower opportunity cost to produce something, it's best for them to produce it. So if a country has a lower opportunity cost in producing a specific good, we want that country to specialize in producing that good because they have a comparative advantage. And it is efficient if they specialize in that good and trade that good with another nation. So that's what we want. We want countries to specialize, and that's what they call the Ricardian model of trade. It's very important, and that's what keeps trade efficient. So this keeps trade efficient. So that's the key to trading, and that is why developing nations / underdeveloped nations specialize in low tech manufactured products, and developed nations specialize in high tech manufactured products. So that's why, because the developed nation has a lower opportunity cost in producing high tech products, and the underdeveloped / developing nation has a lower opportunity cost in producing low tech products. So yeah. And then the national comparative advantage is the ability of a nation to perform an activity or produce a good or service at a lower opportunity cost than any other nation. So international trade, free trade theories. So there's a few different free trade theories. So mercantilism, it's pre-16th century. So it takes an us versus them view of trade, and other countries' gain is our country's loss. So mercantilism is not the right view. We want everyone to gain from trade, and comparative advantage trade, everyone gains with comparative advantage trade, except there are comparative advantage trade, everyone gains in theory, but there are a lot of issues because not everything is regulated. So what are the issues that we see with our trade today? So do you want to try one?
The trades that we see, like,
So in terms of trade today, like when we trade with places like India, China, and other developing and underdeveloped nations, what are the issues we usually see with worker conditions
oh, in
and
those places, well, they usually overwork their workers, like sweatshops in China.
can you say it again one? Sorry.
So they usually overwork the workers in China and in India, since they have an over demand of workers over there, and to make it cheaper and reduce costs.
Yes, agreed. Yeah. So yeah, the costs are usually cheaper because they usually the cost of living in developing and underdeveloped nations is lower. So companies don't have to pay as much of a wage to workers in these areas compared to developed nations. Yeah. Thanks, Juan. And then what do you think? So Olivia, do you want to try? What are the issues that we see with our trade today?
I mean, if we're taking advantage of their land, then that can like drive climate change and that kind of stuff.
Yeah, that's a good point. Yeah, taking advantage of their lands can drive climate change. Yes, exactly. So pollution from manufacturing and land use can drive climate change in those areas. That's great. That's great, Olivia. And then so Zachary, what are some other issues that we see with trade around the world?
I don't know if I have a specific example, but just in general, if there's a certain country that has a resource that a lot of other countries don't, they can do whatever they want with the price almost and like use it against them.
Yes, exactly. Yes, exactly. So like good point with that. Like for example, Saudi Arabia is one example. They have a very high control of the oil supply, and they can change the price through restricting supply or increasing supply. So they have a lot of power because they have so much oil that they can restrict the market where they reduce supply so the price would go up, or they can increase supply and the price goes down. Just they have so much oil that they can do that. So that's a good point, Zachary. I'd also say sweatshops are a big problem. Sweatshops are a big problem. like slavery. So slavery does happen in terms of world trade, and bad working conditions. So bad working conditions. Foxconn in China produces iPhones, and the working conditions are brutal. So those types of issues. There's also, yeah, low pay. When I said the cost of living is lower in those countries and they don't have to pay them as much, they still don't pay them a living wage in a lot of cases. So so in this case, they don't even pay enough in a lot of cases for people to have a living wage in these areas. So they may not even pay enough to have a living wage. So that does happen too. Like, they don't have to pay people as much in those countries for them to live, but they don't even pay them that. So that's a big problem with trade. So these are a lot of issues that we have, and this is why trade has a lot of issues, and they need to iron these out. But a lot of that has to do with boycotting companies is a big way you can stop the companies from doing this. Protesting, that's a good way to stop a lot of these practices. Make your own company that doesn't have these practices, that is fair trade and doesn't cause a lot of issues to the environment and worker rights. So those are types of things you could do to prevent those issues. So free trade theories and mercantilism, that's when you take an us versus them view of trade. Other countries gain as our countries loss. Absolute advantage. So here, this is win-lose, that's mercantilism. Absolute advantage is when like one country produces everything. And then comparative advantage is when every country specializes. So every country specializes in the good they have a comparative advantage in and trade. So that's the comparative advantage strategy. And then specialization of production, free flow of goods benefit all trading partners' economies. So the comparative advantage approach is the best of all these three theories, because the comparative advantage approach is the best free trade theory. It is the most efficient. And US and Canada use this strategy. So yeah, it was created by David Ricardo. And Ricardian model is what David Ricardo made. And the Ricardian model is basically saying specialize in what you are good at, like specialize in what you have a lower opportunity cost in, and trade it with another country. So that's what the Ricardian model is. So that's what we want out of our trade. So mercantilism was 16th to 18th century, and it was the dominant school of economic thought in Europe through the late Renaissance and early modern period. So mercantilism, the goal is to strengthen and enrich the country so it can compete with other empires. Primary objective was to increase the power of the nation state. It promotes imperialism, colonialism, tariffs and subsidies on traded goods to achieve that goal. A nation's wealth depends on accumulated treasure. Encourages domestic production and exports, discourages imports. Theory says you'd have a trade surplus, maximize exports through subsidies, and minimize imports through tariffs and quotas. So that can cause a lot of issues. What types of issues do you think would be caused by this approach? So anyone can volunteer.
Maybe high competitiveness among different countries and focus on personal success and governmental success rather than teamwork, quote unquote, with other countries.
Yes, yeah, that's a good point, Alexandra. Yeah, that's a good point. So lack of lack of collaboration would be a problem. That's great. And then also here, this would cause so they would not benefit from imports here. So maybe another country has a lower opportunity cost in producing certain products for this certain products. And
This
in
would
the
also
Mercosur,
just-
oh, go ahead.
It would also just like create a positive feedback system where the rich would get richer. Like you have to have many resources to start in this. Right? So you have
Ye-
to have that advantage to start, and then only those well put together or well nations that have all these resources would benefit, and the ones that don't have anything would never build up their place in trading.
Yeah, that's a good point there. Yeah, that's great. Yeah, so the rich, it would be this would increase a lot of inequality. So this would increase inequality because the rich get richer in terms of fortunes growing at the expense of the poor. Yeah, that's great. So that's a good point. That's the type of thing that would happen. Can anyone think of any nations that are currently like going through this? Are there any
United
examples that you can think of?
I'd say United States because they abuse developing countries' power of production and manufacturing, but they do not give enough of comparative advantage towards other countries while taking the manufacturing goods.
I'd agree I'd agree in some of these areas. Like for United States, I think United States would definitely meet a lot of these criteria. I would say, yeah, I think you're right in terms of the primary objective is to increase the power of the nation state for sure. Imperialism, tariffs and subsidies to trade goods to achieve that goal, accumulated treasure. I think for this here, I think this point here, this would be for the tariffs. So the US would have the mercantilism approach with the Buy American policy. So that would definitely be for that. And also when they put tariffs on Canadian softwood lumber and steel. So they would follow the mercantilism approach in that case. But I think but when the US buys from China, that would be the comparative advantage approach. So I believe that the US would follow a lot of the mercantilism approach with softwood lumber and steel and buy American, but in other cases they would follow the comparative advantage approach. So I think it's like a case by case basis thing.
Sounds good.
So did your what do you mean by that response?
Oh, I was wondering, like, is it China then, since it probably imports do you want to maximize the export? That means what the stuff you take out of the country, right?
So maximizing exports is good in terms of exports are good. Exports increase economic growth. But Imports are good too, because we can trade for goods from other countries. So like, let's say if we buy from Chinese manufacturers, we can get iPhones produced cheaper than if we produce them in the US. So imports are more cost effective than producing it inside of our country. So we trade a lot with China. So we trade a lot with China because the cost of production in China is lower. So that provides a lot of benefits to us, and that's why we trade with them.
Oh, okay.
So
I thought you
that-
were asking a country that would follow this theory. I was like, China probably.
Oh, no, definitely not. China would be yeah,
be-
China wouldn't follow this theory. I think the US follows the theory with certain products like softwood, lumber, and steel. But there are very few countries that would follow this theory completely. It's usually just for like certain specific products.
Okay. That's good.
But yeah, thanks for bringing that up, Didier. So here I'll share this with everyone. So it's in the chat now. So what I'll do is so I'm just gonna take another screenshot here. So that's sent, and then I'll just clear this, and this is in the chat for future reference. So yeah, the former US administration, they followed a lot of the mercantilism approaches. So the former US administration did that. And then the theory of absolute advantage. So Adam Smith, Wealth of Nations, 1776, was the capability of one country to produce more of a product with the same amount of input than another country. So a country should specialize in production of and export products for which it has absolute advantage, import other products. So this approach, certain examples of this would be that oil producing nations in the Middle East, Central and South American nations producing coffee, Chile and Zambia having large reserves of copper, Italy and wine production. So all four of those examples, they have the absolute advantage in producing those products. So they would just produce them in country and they would not trade for them. So the issues with that are that you're not trying to find a low cost producer. So it's best to, if you can get it cheap, if you can get something cheaper by getting it produced somewhere else, then do that. Yeah, so sometimes it's better to, so the problem with absolute advantage is that you are not benefiting from getting a lower cost producer to produce a certain product. So if you can buy from a lower cost producer in a different country, it is best to do it from an efficiency view. So that's the problem with absolute advantage. So absolute advantage, mercantilism weakens country in long run, enriches only a few. Smith argued against the belief that trade was a zero-sum game, that the gain of one nation from trade was the loss of another. So trade is a positive sum game, both nations gain. I do believe that trade is a positive sum game and both nations gain. And I think that's a good view. I think this view here, this is a good view, but I prefer the comparative advantage approach. So I think that his view of trade is good, but the strategy is not what I think is right. I think you need to use the comparative advantage approach. Specialization in trade. Theory of absolute advantage. An advantage in production comes from better skills, equipment, or the resources. A country will have a great advantage in pineapples if it possesses the right type of soil and climate, but the same country may well be at a disadvantage in growing coniferous trees. So nations like firms and individuals should specialize in producing goods and services for which they have an advantage. So they should trade for goods and services for which they do not enjoy an advantage. So let's bring up this table below. Shows the productivity per worker, average product in each country, and which country should specialize in which product according to absolute advantage. So based on this, for Fredonia and Liberland here, which country should specialize in beer and which country should specialize in wine?
I think Berlin for sure should specialize in wine, but I'm not sure if Fredonia should specialize in actually, yeah, maybe Fredonia should specialize in beer, but they won't have I don't know, 4-1 versus 3-4, so they will have 75% advantage versus 25% of Liberland in wine.
Yeah, so good points, Alexandra. So for this, for absolute advantage, we look at the columns. So here, compare the data in the columns for absolute advantage, and then figure out which number is bigger. So that's pretty much all we do. That's pretty much what we do for absolute advantage. So whatever number is bigger here. So if the number for Fredonia is bigger than Liberland or so on, which would be, so if one country has the bigger number, that would be the one with the absolute advantage. So in that case, which country will have the absolute advantage for which good?
Fredonia will have it for beer and Liberland will have it for wine.
Yes, exactly. Excellent. And then Liberlands will have an absolute advantage. For one. Great job, Alexandra. Yeah, so 4 is greater than 1. That's excellent. So that's how we do it for absolute advantage. It's the columns. And then for comparative advantage, it's the rows. So that's the difference between those here in terms of the comparative advantage and absolute. So absolute's columns here. So Fredonia should specialize in beer and Liberland should specialize in wine. You did a great job on that one. That was great. So here, so we have all this data here. Suppose that initially the working population of each country is 20 million people with 10 million working in each industry. What is the total output of the two countries?
Should we multiply the given advantage number in each of the categories by the number of workers in each of the countries?
I think that's a good start. I think I'm just gonna double check here. Yes, I believe so, yes. So yeah, do that.
So
And
he-
then, yeah, so try that.
Okay, so Fredonia will have 40 million
Yes.
and Liberland will have 30 million in beer production.
Yeah, that sounds good. Yeah, great job. So yeah,
I
40
think
million
we-
Fredonia
Mm,
and then
okay.
40 million Liberland. So yeah, I think that's correct. That's great.
I think
try
30
this.
million in beer, but 40 million in wine.
So let's check this here. So here, okay, so they're just looking for this one. They were just looking at the,
Total number.
yeah, like before we specialized. So that makes sense here. I was, yes, so here that makes sense. So they would just multiply 10 million to each here. And I think the next question will be that, I think the next question is when you specialize. So I think they just wanted to show us what it would be for specialization. So I think in this case, I think that the half of the workers are working in each industry. So like half of the workers are working in beer. Half of the workers are working in wine. So for the next question, I think that all of the workers will be working in one or the other. So we would take 20 million times beer and then 20 million times wine. So I believe that's what we'll have to do for the next question. So let's try that. I'll just send this over. So excellent. So here it is. Yeah. So here, suppose that each country decides to specialize in the product in which it has a competitive advantage. What will be the total output of each product? What are the gains from trade? So 20 million people will work on the one product. So like beer/wine. So yeah, so 4 times 20 million, 80 million, then 4 times 20 million, 80 million. So that would be beneficial in this case because instead of producing 70 million with no trade, you produce 80 million beer. And instead of producing 50 million wine with no trade, you're producing 80 million wine. So you benefit, so beer and wine production increase due to trade here. So So it shows that there's a clear benefit, and this is, yeah, this is a good application in terms of showing the benefits of trade in this case. So gains are 10 beer and 30 wine. And then comparative advantage, I believe this is the better theory here. So it's not absolute advantage, but comparative advantage that provides mutual gains from trade, the advantage of producing at a lower opportunity cost than the others. So countries should specialize in production of those goods in which it is relatively more productive, even if it has an absolute advantage in all goods it produces. So absolute advantage is a special case of a comparative advantage. So comparative advantage, each country has a trade-off opportunity cost for each item it produces here. So to analyze this, you would have to compare the rows instead of columns in this case. So that's what you have to look at for comparative advantage. So compare rows for comparative advantage. We'll go through an example on how to do that. So here, the US in this case is comparatively better at making wheat because it gives up 1 bean, while the Philippines gives up 3 beans for every wheat. So so here it's like 3 beans per 1/3 wheat. So here, so they actually did the calculation for us here. So so in this case, the United States can produce 1 wheat for every 1 bean, and that's found right here. And then the Philippines can produce 1 wheat for every 3 beans. And that's found there. And then here, the United States can produce 1 bean for every 1 wheat. And then here, the Philippines can produce 1 bean for every 1/3 wheat. So so they did the calculations for us for this, which makes it easier. Yeah, so that's how we would interpret that, and I'll send this over. So based on this here, what product should each country specialize in?
For the
Philippines.
US, it doesn't matter because it's equal either way, but because the Philippines is better at producing beans than they produce beans, then I guess in this case, then the United States would take wheat.
Yes, exactly. Yeah. So yeah, exactly. So United States would produce wheat because it costs less beans for them to produce wheat. And then the Philippines would produce beans because it costs less wheat for them to produce beans. So that's exactly what would happen here. And then production without trade. So the production would be lower without trade. So here, this is what they would produce without trade. So 320 wheat and 220 beans. And then specialization with trade, they would produce 80 more wheat and 80 more beans. So with trade, they would produce more wheat and more beans in this case. So this this is beyond the scope here. And then this graph is a good representation of the benefits from trade. So as we trade more, like before trade, this is where we would be. And after trade, everything we produce more and more and more. So as we trade, there's more production for everything. So this is a very accurate description of what trade does for our economy, because it always leads to improvements, but there are a lot of costs, like I outlined, that need to be we need to get rid of. We need to get rid of those costs, and we need to get governments to get rid of sweatshop labor, get rid of bad working conditions, get rid of like worker slavery. We need to get rid of all those issues, because those are hidden costs of trade that the government has to get rid of. And there has to be a lot of changes to trade. So here, so that's a lot of what I know we glossed over some of that stuff in the past in terms of trade, but I wanted to go through it more in detail, because it's very important for how our trade system works in our nation. So let's get started on exchange rates and balance of payments. So let's get started on that here. So exchange rates and balance of payments. So financing international trade. So we've seen how the exchange rate is determined, but what is the effect of the exchange rate? I know we've went through it in previous classes. What does the exchange rate do to trade?
Depending on the exchange rate, the countries that are in this exchange will either gain or lose in terms of benefit. So it's important for other countries to establish what the exchange rate will be, so both of the parties can benefit in either way.
Yes, exactly. Yeah, good point. Yeah, so exactly. So the exchange rate affects trade and can lead to losses for other countries. So that's a good point. Like a lower currency value increases exports and reduces imports, and then higher currency value increases imports and reduces exports. So yeah, good point, Alexandra, on that one. So there's a lot of effects of a change in exchange rate. And then how does, so I kind of answered, so we kind of answered that one. How does currency appreciation or depreciation influence Canadian international trade? So currency appreciation, we can afford more imports. Currency depreciation, we can sell more exports. So that's what happens with currency appreciation and depreciation. So there's a lot of benefits to both strategies there. And then we record international transactions in the balance of payments accounts. So financing international trade. So balance of payments accounts. So countries' balance of payments accounts records as international trading, borrowing, and lending. So there are 3 balance of payments accounts: the current account, capital and financial account, official settlements account. So the current account, it records receipts of exports of goods and services sold abroad, payments for imports of goods and services from abroad, net interest income paid abroad, positive receipts are greater than payments. Net transfers such as foreign aid payments, positive receipts are greater than payments. The current account balance equals, this equation here is really all that's important for this topic here. Let's just summarize it. So it's exports minus imports plus net interest income plus net transfers. So yeah, so in other words, so the current account balance, it's exports minus imports plus net interest income paid to other countries plus foreign aid payments. So that's how it's calculated. Financing international trade. Capital account records receipts, foreign investment in Canada, payments, Canadian investment abroad. So it shows the movement of Canadian foreign currencies as a result of the buying and selling of assets internationally. So it's due to buying stocks or bonds and also investing in real estate or a whole company. So here, I think we'll shift, here active, so Canadian movie chain purchased the rights to screen Italian film in Canada. That would be classified as a payment in this case. Then an American family purchased a Canadian made trailer for their summer vacation. This would be classified as receipts. Canadian sends a monetary gift to relatives in India. This would be a payment. And then a Canadian shareholder receives dividends from a Japanese corporation. That would be a receipt. So here, payments, receipts, payment, receipt. So this is this is totally optional. Like, this is not, I'm not going to test you on receipts and payments. It's just more for subject matter knowledge in terms of trade accounts. So the settlements account is part of the capital account, records the change in Canadian official reserves, which are the government holdings of the foreign currency. So if Canadian official reserves increase, the official accounts settlements account is negative. Why? Holding foreign money is like investing abroad. Canadian investment abroad is a minus item in the capital account. So the sum of these balances on the 3 accounts equals 0. So if you add them all up, it equals 0. So to pay our current account deficit, we must borrow from abroad, then we must borrow more from abroad than we lend abroad. Use our reserves to cover the shortfall. So those are the things we can do to cover our current account deficit. So to pay our current account deficit, we can borrow more from other countries, or use our official reserves to pay off the shortfall. So we can do that to, yeah. And then the current account balance for Canada in 2019 was this, so it was negative 47 billion here. So it was this. So they had to, in this case, Canada had to borrow money to pay this off or use their reserves to pay it off. But likely they had to borrow to pay this off because Canada doesn't have that much reserves. So they had to borrow to pay this off. And that led to more debt for Canada. So they had to borrow more to pay that off. So they had a current account deficit of $47 billion. And how do we pay for imports that exceed the value of their exports? Borrow money or use reserves. And you pay for the current account deficit through borrowing money or using reserves. So we pay our current account deficit by borrowing from the rest of the world. Our foreign borrowing was $42 billion. The statistical discrepancy between the capital account and current account transactions was 3 billion. So the capital account balance was 45 billion. So Canada had to borrow. Canada didn't have. Canada lost 2 billion in reserves, so they had to borrow to make that up. So in this case, an example of a real life balance of payments accounts. Someone earns $25,000 of income, earned interest income of $1,000, has an income of $26,000 through adding those two up, and then had about $78,000 in payments. So in this case, the expenditure was 78,000. Income was 25,000. How did Jackie pay the rest?
She must have like a loan of some sort to cover those additional costs. Isn't that?
Yes. Yes, exactly. What else you can say, Hannah?
No, I think that's pretty much it. Just like either a loan or whatever money she had like saved up, maybe. I don't know if that's, I don't know.
Yeah, yeah, exactly. Those are good points. Yeah, so yeah, good points. Loan or savings to pay the rest. Yeah, that's exactly it. So here, yeah, loan or savings to pay the rest. And it's the same as the government. The government does the same thing. When I say reserves, that means reserves are the word for government saving. So the government does the same thing. The government does the same thing as a household if they don't have enough income to cover expenses. They borrow to pay off the extra expenses or use savings. So the government does the same thing as we do, pretty much, but they have more access to lending. So yeah, good job on that, Hannah. So So yeah, use money that she has in the bank, currency reserves, or take out a loan, borrow. So you got that perfect. So that's exactly what Jackie would have to do here. So here, suppose she borrowed $50,000 to help buy her house, and this loan was the only borrowing she did. So she would have to find the other $2,000 probably through savings in that case. So she's still $2,000 short, so she got it from her own bank account. So she got it through her savings. So she covered $50,000 through borrowing and then $2,000 through savings. So that's usually what happens. They cover part of it through savings and part of it through borrowing. So here the balance in the current account equals -63, which means that 63 billion more in foreign reserves left Canada than entered Canada. Then foreigners purchased a lot more Canadian assets, 258 billion, then Canadians purchased foreign assets, 190 billion. This represented an inflow of over 68 billion into Canada. So we had an outflow of funds, 63 billion in the current account, but an inflow of 68 billion in the capital account, giving an overall surplus of 5 billion. So that's great. So we got through that in terms of the good job, great participation, everyone on that. So we will continue on more focused on that. We'll continue on that. And then so arbitrage, I'll introduce arbitrage. Arbitrage is the practice of seeking to profit by buying in one market and selling for a higher price in another regulated market. So this is very hard to do now. This is very hard to do today because the internet is so fast and information travels instantly. So the prices in one market will adjust to the same prices in another market. Unless you figure out a market that doesn't adjust. So in this case, in the past, when the internet didn't exist, certain businesses could buy stock in one market. So let's say the New York Stock Exchange, and sell it in another market. So let's say the London Stock Exchange, for a higher price in London compared to New York. So that's what they call arbitrage. So this is called arbitrage. So you can make a great fortune doing this if you can figure out two markets that have two different prices for the same thing. So like, if you could figure that out, you could buy the product at the lower price in one market and sell it for the higher price in the other market. So that's the benefit of arbitrage. So there are potential opportunities with arbitrage today, but you really have to seek them out they're not as common as before, just because of the internet. The internet has gotten rid of a lot of arbitrage opportunities because of the speed of information flow. So put that in the chat there. So in this case, buy a $50 share of A at NYSE, sell the share on the Indian exchange for 4,250 INR, convert back to USD 75 INR / USD, and then you'll make a profit of over $6. So that's that case, that arbitrage would work. So you could do arbitrage in this situation where you buy the stock at a lower price in the New York Stock Exchange and sell it for a higher price on the India Stock Exchange. So that's a potential benefit you can have. So arbitrage in the foreign exchange market, international loans and goods markets achieves 4 outcomes: the law of one price, no round trip profit, interest rate parity, purchasing power parity. So arbitrage, speculation, market fundamentals. So example, the law of one price. iPhone sells for $1,000 on eBay and $1,500 on Amazon. Opportunity for arbitrage, making a quick profit by buying on eBay and selling on Amazon. So if you can identify those types of situations, if you find something like this where the price is lower on one website than the other, you could buy it on that one website at the lower price and then sell it on the other website for a higher price. So eventually people start seeing that and they start selling it, buying at the lower price and selling at the higher price. And they start doing that. And then eventually the price adjusts. So it's very similar to the market, the supply and demand graph. So here, the supply and demand graph, I'll just demonstrate here. So price, quantity. So right here, the supply, demand. So under arbitrage, it would kind of be like this. So here it's price you buy at right here, and then price you sell at. So this would be the arbitrage example. So you'd buy at this price that's lower right here. So you'd buy here and you'd sell here. And then eventually the gap would close over time because when everyone knows about it, so the gap would close over time because once everyone knows about it, the price will adjust back to equilibrium. But in short term, you can make money on arbitrage. But long term, prices go back to equilibrium. So this is a potential way you could apply this to your regular life and find opportunities for arbitrage. So the law of one price. Law of one price states that if an item can be traded in more than one place, the price will be same in all locations. No round trip profit. So a round trip is using the currency A to buy currency B, and then using B to buy A. Arbitrage removes profits from all transactions of this type. So here, the interest rate parity, the return on a currency is the interest rate on that currency plus the expected rate of appreciation over a given period. When the rates of returns on two currencies are equal, interest rate parity prevails. Interest rate parity means equal interest rates when exchange rate changes are taken into account. Market forces achieve interest rate parity very quickly. So purchasing power parity, currency is worth the value of goods and services it will buy. the quantity of goods and services that one unit of particular currency will buy differs from the quantity of goods and services that one unit of another currency will buy. So that just basically means each currency, that means that certain currencies are more valuable than others. So like certain currencies can buy more goods than others. So that's the other word for, that's the other explanation for what that was just said here. Certain currencies can purchase more than others. And then when two quantities of money can buy the same quantity of goods and services, the situation is called purchasing power parity, or PPP, which means equal value of money. So the value in money, so the value in money is the amount of goods and services you can purchase with money. Yeah, so that's what the value of money is here. So it's just the value comes in the amount of goods and services you can purchase. So example, price of t-shirt in Canada is $22. Price of t-shirt in Europe is 15 euros. The actual exchange rate does not equal this, and it's possible to make a profit by buying t-shirts in one country and selling them in another. Thus, demand and supply to change to make this equality hold. So again, arbitrage is buying a commodity in a market where price is low and immediately selling it in another market where price is higher. So purchasing power theory, purchasing power parity does not generally hold because of many services, such as haircuts, are not traded internationally. So haircuts can't be traded internationally. So like haircuts in lower income nation would be cheaper than haircuts here because we cannot trade them. And we cannot trade them. We cannot usually trade services. So the prices don't adjust. So if we could trade services, the prices would likely adjust. And there would be one price across all countries. So that's the case here. So services, you can't really trade services, like specifically in-person services cannot be traded. So the price will not be the same in different countries. That's a big reason why services in other countries are different prices. Yeah, so that's a big reason why here. Transportation insurance costs, tariffs and other trade restrictions, particular preferences by consumers, the effect of the value of currencies of trade and financial assets. So purchasing power parity theory. So knowing the Big Mac is sold over the world, The Economist magazine wondered if local prices converted to US dollars might tell us how far a country's currency is from PPP. So they use the Big Mac index to determine a country's dollar price of a Big Mac. So they do this thing called the Big Mac index, and it's pretty accurate. So it shows you how much one has to spend in different countries in order to get the same basket of good. So in Switzerland, the Big Mac is worth the most if we adjusted it to US dollars. Like if we put it in the US dollar, if we converted the Swiss franc price, if we converted the Swiss franc price of the Big Mac to US dollars, the price of the Big Mac in Switzerland is highest in this case. So this index, it converts each currency's price of the Big Mac to US dollars. So this Big Mac index converts the nation's currency price of the Big Mac to US dollars to compare across countries. So is the Big Mac index telling the truth? So I'll ask the class, do you think it's a good measure of purchasing power of a currency?
Not really, because the price of the Big Mac by itself can change a lot depending on the logistics, how the meat's getting there. I mean, it can be good for shock value, but it should be something more universal, like housing.
Yeah, good point, Juan. I agree. I think there's a lot of other necessities that are included in this. This is only for like food. So we're leaving out a lot of other factors. So like Juan said, housing, transportation, those aren't factored into this index, which provides a lot of biases here. So it's not telling the truth. Big Mac looks and tastes the same in all places, but most of its value is service. So the prices differences arise from different prices of services that arise from different wage rates, not from over or undervalued currencies. So it's not a good measure. So as Juan said, Juan was right. It's not a good measure of how valuable a currency is. So speculation. Speculation is trading on the expectation of making a profit. So speculation is different from arbitrage. So arbitrage is trading on the certainty of making a profit. So most foreign exchange transactions are based on speculation. So a lot of what has happened with Bitcoin is it's been speculation. So you speculate that the price will go higher based on a lot of, like, you may believe it's going to go higher. It's a big risk. So a lot of what has happened in crypto is it's all speculation, where you believe it's going to be higher, but there's a lot of risk. So the expected future exchange rate, an expectation is a forecast. So forecasts are a lot of the time wrong. So there's a lot of uncertainty to exchange rates. So if you're going to buy a currency, let's say you want to buy the Canadian dollar as an investment, there's a lot of uncertainty in the value of the Canadian dollar. Then also there's a lot of divergent forecasts. Some forecasts might say that the Canadian dollar, let's say, will go up in value. Other forecasts will say it will go down. Other forecasts will say it will stay consistent. So we're not certain how it's going to do. And then the forecasts influence the outcome. So that can get into a lot of issues with morals. The problem is they could be manipulating. A big problem is they could be manipulating the price of a currency based on forecasts, which would be illegal. So like stock or currency manipulation is illegal. So you can't manipulate the price of stocks. So don't manipulate the price of stocks, currencies, investments. So that's illegal there. So that does happen a lot. They create forecasts to manipulate the price, and that's illegal. So that's cautionary tale there. Exchange rate volatility. So an exchange rate might rise one day and fall the next as news about the influence in the exchange rate change the expected future exchange rate. the influence of expectations, the constant arrival of news, but the influence of supply and demand, make changes in exchange rate impossible to predict. So the real exchange rate. It's similar to real GDP, where you take out the influence of price. So it's just based on the value of products and services. So the real exchange rate is removing the influence of prices, like of price changes, rather. The influence of price changes, and only comparing current or past prices of domestic and foreign goods and services. So that's what the real exchange rate is, and it's a good measure on showing the two values of currencies in this case. So it shows, so the real exchange rate shows how much real GDP you can buy in other countries with our GDP. So we'll just skip this here. So exchange rate policy. So we talked about this a bit in the past. So 3 possible exchange rate policies: flexible exchange rate, fixed exchange rate, and crawling peg. So the flexible exchange rate is when the government allows the exchange rate to be determined by demand and supply. So the central bank doesn't directly change the exchange rate. So yeah, with a flexible exchange rate, the central bank cannot directly influence the exchange rate. Yeah. But they can change the interest rate and money supply, which will likely then influence the exchange rate. Fixed exchange rate is when the central bank sets the exchange rate. So the fixed exchange rate is when the government or central bank changes the exchange rate directly. So we'll skip this here. So floating versus fixed exchange rates. So floating currency reduces the need for foreign currency reserves. Freedom to set policy interest rates to meet domestic objectives may help to prevent imported inflation. Insulation for an economy after an external shock, especially for export-dependent countries. Partial automatic correction for current account deficit and less risk of speculative attack. And then fixed exchange rate, the government / central bank can set the exchange rate wherever they want. And they do this to increase exports in a lot of cases. They artificially set it low, and a lot of countries have used this where they've set the currency artificially low to increase exports. So that's an example of why they would use fixed currency to artificially set the price of the currency low. And then crawling peg is when it's kind of a merge. So crawling peg is like if they merged parts of the fixed and flexible exchange rate together. So they change the exchange rate target regularly. So it's very similar. So the crawling peg is more similar to the fixed. exchange rate. So it is a fixed exchange rate with a changing target. So okay, it may go up or down depending on the priorities of the government. So that's what a crawling peg is. So we got through that here. So we went deeper into that. We'll take a 10-minute break and then we'll go through a lot of the application of this material to investing. So we'll take a 10-minute break and we'll come back at 4:47 and then talk about more of the applications to investing. So let's get started again. So we'll go through some applications of our course content to investing. So value investing is a big strategy that they use in investing. Warren Buffett is one of the pioneers of the strategy. And yeah, he's been the most successful investor in history, a lot based on this strategy. So who is a value investor? So they invest in low price to earnings stocks, and that's what a value investor is. So price to earnings, that means the price of the company divided by the net profit of the company. You want this to be low, like 10 is a good number for this. Like 10 is a good number, like usually, so you see companies in banking have 10 to 20 price to earnings. Like railroads, usually 10 price to earnings. And then tech companies can range from like 50 to 100. So the lower the price to earnings, the better usually. So another widely used definition is there investors interested in buying stocks for less than what they are worth. So it's too broad of a definition because you can talk about most investors as value investors because most active investors are doing that. So they buy stocks for less than they are worth. So I'll put this in here. So price to earnings is one of these stats that we use, but there's others. So as a value investor, the important point here is you want to buy a business only if it trades less than the value of the assets in place. So you want to buy it for less than what it's worth, pretty much. So you want to buy it less than, so like ideally you want to pay as little as possible. So like pay as low as you can for the company. So that's really the strategy for investing. So if you can pay for the company at less than the net asset value, that is a potential good strategy. But there might be risks to that because the company may be going through a lot of troubles, and that is why the company value is low. So that's one of the issues that happens, and it might be cheap for a reason. So make sure that if it is cheap for a reason, just figure out why it's cheap. So like every company, so like if it is too good to be true, it is. So yeah, so if it's too good to be true, it is. Be very careful in investing. So there are so many scams. There are so many scams out there. So if the company is cheap and it is priced low, it is usually for a reason. So make sure you know all of the risk factors of the business. So that's very important. Know what the problems are with the business, what the like know what the problems are with the business, know the benefits of the business, like know everything. So that's very important. So it's important to do like a pros and cons list about the business. So go through all of the pros and cons of the business and do analysis of that. So there's goods and bads. So you need to analyze both sides and determine what to do going forward. So I'll send this over here. So that's in the chat now. So different phases of value investing. So passive screeners. So you screen for stocks that have characteristics that you believe identify undervalued stocks. So you want to find market mistakes through these screens. Contrarian investors. These are investors who invest in companies that others have given up on, either because they've done badly in the past or because their future prospects look bleak. You are implicitly assuming that markets overreact. And then the activist value investors. So they invest in poorly managed and poorly run firms, and they try to change the way the companies are run. So the passive screener, it was used by Ben Graham, who was Warren Buffett's mentor. And you have to look for companies that are cheap in the marketplace without any of the reasons for being cheap. So high risk, low quality, growth, low growth. So look at those reasons there. So Warren Buffett has used this strategy for many years. And his company, Berkshire Hathaway, has beaten the S&P 500 for many, many years. And today, like going up to today, it's pretty, the return has been higher than S&P 500 even if you extended this graph to today. So Buffett's key success are the business should be simple and understandable. The firm should have a consistent operating history that has consistent operating earnings, and the business should have favorable long-term prospects. And the managers of the company need to be trusted. So they need to be leaders, not followers. And then it must have a high return on equity. So return on equity you can find in Google Finance, Yahoo Finance. That's a stat you can find in all those online financial search engines. So return on equity is something you can find there, and you want to have a high return on equity, and then also high and stable profit margins. So those two stats, high return on equity and high and stable profit margins, are key for good investments. So that's something to look for. And then, yes, that's very important. And then you can buy valuable companies at cheap prices when investors turn away from them. So investors may turn away from them because of many reasons. There might be some bad news with the company. There may be bad news about the company that will not affect the financials of the company, but the stock goes down. So buy when this happens. So if there's bad news about the company and it won't affect the financials, buy. Like if the stock goes down because of it and it won't affect the financials of the company, buy it then. So that's a good strategy. And Warren Buffett's used that a lot of the years where he's just bought it at a cheap price because there's been bad news that has brought the stock price down. So here, yeah, the success of Berkshire Hathaway has been very high over the years, showing that it's grown so much over the past few decades. And then, yeah, be like Buffett. So markets have changed since Buffett started his first partnership. So it'd be hard for Warren Buffett to replicate his success today because there's information widely available about companies, and many money managers, they claim that they are doing the same thing as Warren Buffett is doing. So now Buffett, in recent years, he's been developing more of an activist investment style. And as a small investor, we're not able to do that, but he can, because what he can do is he can buy a whole company and then just change it from the ground up. And that's what an activist investor does. And that can be a big profit. You can make a lot of profits through just buying a whole company and retooling it. And that's what he does also. And then Buffett's success has been patience. So he does not buy stocks for the short term, but businesses for the long term. So he holds stocks through bad years and is just patient. So he doesn't sell them, he just holds them. So that's key. So just don't sell your stock. So that's a very, so if you own banks and railroads, which Warren Buffett usually owns, those are very big companies that he owns. He loves banks and railroads. If you own banks and railroads, don't sell them when they're doing badly. They will recover. Just wait. So companies like banks and railroads, they will always recover. You just have to hold them. And when they go down during recessions, don't sell them. So as long as they're good businesses, like banks and railroads are, like BMO, TD, for example, CN, CP Rail, those are great businesses. And as long as you hold them and just hold them for a long time, they will do well. They might not do well during recessions, which is likely, but eventually, like if you hold them over a long time period, they will always recover and they will grow more than they did before. So that's a big part of his success. So Warren Buffett, Ben Graham, they look at price to book ratios. So one of the things that they look at is buy stocks where equity trades at less than book value, or at least a low multiple of the book value of equity. And then price, so book value just means net assets. So book value is assets minus liabilities. So equals net assets. So that's what book value is. So you want to, so buying a company for less than book value, you're paying less for the company than the value of their net assets. So that's a good strategy. And then price to earnings ratios, you want to have a low price to earnings ratio, or low price to earnings ratio, low price to book ratio, and then low dividend, so like high dividend yield. So does anyone know what a dividend yield is?
Total demand or overall demand, like net demand kind of thing?
Kind of. So dividend yield is it means the amount of payment the company gives to shareholders, to like stockholders. So that's what it is. So when a stock has a dividend, it is the amount of money that the company gives to stock owners each 3 months just for being a stock owner. So for banks, like banks in Canada, if you own BMO, let's say, for example, you get 5% per year in, like, so you get a 5% dividend per year from BMO. if you own the stock. So like, let's say the stock is $100. So let's say the BMO is $100 per share. You will get $5 per year in dividends for being an owner of one share of BMO. So it's a good perk of being a stock owner. If you own stock, you can get dividends. So BMO has a dividend. All of the banks in Canada have dividends. So BMO, TD, RBC, Scotiabank, CIBC, they all have to pay 50% of their profits as dividends to shareholders. So if you own the stock, so in that case, if you own the stock of these companies, you will receive half of what they earn, like all the shareholders combined will receive half of what they earn per year. So that's the benefit of it. They have to give out a lot of dividends to shareholders. So that can be beneficial for you because you can get a payment per year on your stock. So that's one of the biggest benefits of being a stockholder, dividends. So I'll ask the class, so if dividends are a big advantage of being a stock owner, what is the other big advantage?
Maybe buying ability, because you have higher dividends, you have higher chances of investing into more companies and extrapolate on that and enlarge your number of funds.
Yeah, that's a good point. So yeah, so that's called dividend reinvestment. So you could take the dividends and invest them in more stock. So that's a big thing that people do. So that's great, Alexandra. Great point there. Another reason is people buy stock because they want to buy low and sell high. So like buying low and selling high, that's a big reason. So they can make profits by buying low and selling high. So like dividends and buying low / selling high and reinvesting dividends are all benefits of investing in stocks. So yeah, so this is a big benefit of knowing economics, is applying it to these types of scenarios. Investing is one of the big benefits here. So paste that in chat. So price / book value screens, a low price book value ratio has been considered a reliable indicator of undervaluation in firms. So over a long time period, low price to book value stocks have outperformed high price to book value stocks in the overall market. So that's a good point here. That shows that you want to have a low price to book ratio for your stock. So low price to book ratio is better. So I'm going to pull up So I'm gonna just pause this PowerPoint here for a second, and I'm gonna pull up just something from Yahoo Finance here. So you can go to Yahoo Finance here. So here, share my screen. So it's this link right here is Yahoo Finance. And let's look up BMO here. Bank of Montreal. So let's actually look at the one here. Let's look up this one. So here it is. So we can look up all the statistics. I'll just paste this link here. So let's go to profile. Wait, no, statistics here. Let's go to statistics. So here are the statistics for BMO. So I'll post this in the chat here. So P/E is the price to earnings ratio here. So it's about 8.07. So that's pretty low. That's pretty low price to earnings ratio. So that is low, and we want a low P/E. So that's good for us here. And then the price to book is about 1.27. So it's pretty low here. So price to book is 1.27. So you are paying 27% more than the net assets are worth for BMO, which is not that bad. And then I'll bring up the price to earnings ratio again. So it's 8.07. So you are paying 8 times, like you're paying 8 times the value of the profits of BMO. So you're paying 8 times the value of the profits of BMO to buy the stock, which is pretty low. So that's good for us there. And then as you can see here, so let's look at so those are good stats for us to benefit from investing. So I'm just gonna look at the financials here. So if we look at this, their net income has been increasing here. So I'll put this in the chat here. So their net income has been increasing over the past few years. So as we can see here, the net income rose from 5.758 billion in 2019 to just over 13 billion in 2022. So over this time period, it has almost tripled, which is good for investors. So that's a good point there. And then cash flow. So cash flow can be found here. Cash flow is another good measure to use for investing. So the cash flow, if we look at 2019 to present, it's just been increasing a lot. So from 2019 to 2022, the BMO cash flow has risen from 28.175 billion to 46.748 billion. So like basically almost doubled. So BMO looks like a great investment. So that criteria we're looking at here, it's very important for investing. So cash flow, net income, price to earnings, price to book are very important for investing. So yeah, so that's a good, so Yahoo Finance is a good resource for your stock analysis. And also based on your your programs here, biotech, like researching biotech companies would be a great place to start to research for potential investments, because Warren Buffett advises us to only invest in things we understand. So by understanding the biotech industry, it provides the understanding of the business required for potential investment. While someone like me, I understand the banking industry. Like I understand the banking industry, so investing in it is a good idea, but I wouldn't understand biotech that much. So only invest in things that you have a good understanding of, because this will prevent scammers from providing scam investment opportunities and reduce risk. So that's very important. So yeah. And as you're taking this course, you'll be an expert in banking also. So you can potentially invest in banking stocks. Just be skeptical and make sure that you know all the risks and know that there are scammers out there. So here, as they studied the premium earned by low price to book stocks over high price to book stocks, Sweden has benefited a lot from that in recent years. 2011, countries that have benefited from it have been New Zealand, Denmark, Italy, US, a lot of these countries over here. So as we see here, low price to book stocks outperform high price to book stocks in this case over these time periods, except in Ireland, Finland, Switzerland, and Belgium. So those are the exceptions. So yeah, so that's a good stat in terms of determining what to invest in at the price to book value. So that's in the chat here. So that's a great stat to use. And then here, caveat emptor on P/book value, price to book value ratios. So the French have pointed out that low price to book values may operate as a measure of risk, since firms with prices well below book values are more likely to be in trouble and go out of business. Investors therefore have to evaluate for themselves whether the additional returns made by such firms justifies the additional risk taken by investing in them. So this PowerPoint is under March 9th materials. So you can go back to this whenever. So price/earnings ratio screens. So investors have long argued that stocks with low price to earnings ratios are more likely to be undervalued and earn excess returns. So studies which has looked at the relationship between price to earnings ratios and excess returns confirm these priors. So as we can see here, if you invest in the lowest, so as you can see here, as the price to earnings ratios go lower and lower, the returns go up in this case. So as the price to earnings ratios go lower and lower, the investment returns go up. So yeah, so based on this study, a lower price to earnings ratio is better for stock returns. So this graph is very good on showing that here. So you want to have a lower price to earnings ratio in this case. We'll send this over here. So here, based on the price to earnings ratio effect here, firms with the lowest price to earnings ratio class earned an average return substantially better than firms in the highest price to earnings ratio class in every subperiod. So the excess returns earned by low price to earnings ratio stocks also persist in international markets. So as you can see here, there was always a benefit to having a low price to earnings ratio. So here, the annual premium earned by lowest price to earnings ratio stocks over the market, in all these countries, the lowest price to earnings ratio earnings stocks in these countries have returned more money than the market average. Yeah, so the returns have been higher. So yeah, so this shows that the returns are also higher here. And then what can go wrong? Because there's risk factors to all of this. So this is not a foolproof system. Like, there are risks, and these are some of the risks that can happen. So companies with high risk earnings. So some companies may have high risk earnings. So for example, they may be making up their profits. So they may be stating that their profits are high. So they may be stating that their profits are high, but it's all fake. So that's happened in the past where they lie about their profits. So that can be a big issue. So make sure that the company is not a fraud. So frauds do happen, so you got to be very skeptical. And then tax costs. The second possible explanation that we given for this phenomenon is that low price earnings ratio stocks generally have large dividend yields. So this would provide a larger tax burden for investors because dividends are taxed at higher rates during much of this period. So yeah, usually stocks with low price to earnings ratios have high dividends. So like income trusts are like this. Income trusts are similar, or income trusts have low price to earnings ratios and high dividends. So that could be a reason why there's a low price to earnings ratio. So that could be the potential reason. And low growth. Third possibility is that the price to earnings ratio is low because the market expects future growth in earnings to be low or even negative. So yeah, so the price to earnings ratio may be low because the earnings growth is low. So that could be another reason why. So these are a lot of risk factors that you got to look at before investing, and there's many more. Like just try to be as careful as you can with all of these risk factors. So I'll put this in the chat here. So here, revenue multiples. So they compared the performance of low price sales ratio portfolios with low price to earnings ratio portfolios. It concluded that low price to sales ratio portfolios outperform the market, but not the low price to earnings ratio portfolio. So in this case, just go back to that. So Jacobs and Levy concluded that low price to sales ratios by themselves yield an excess return of 0.17% a month between 1978 and 1986, which is statistically significant. So price to sales is another good metric to look at, and that's in statistics under Yahoo Finance. So what I'll do is I'm going to just pull up Yahoo Finance again and show you where that's located. So you go to statistics under Yahoo Finance. So share here, and then click statistics. And then price to sales here would be under valuation measures. So it's about 3.14 for BMO. And I would recommend looking at other banks and figuring out what their one is. So here, price to sales, it's 3.14 for BMO. So it's 3.14. And let's look up TD. Look at TD's price to sales ratio. So TD is 3.32. So BMO's is slightly lower than the TD's. So paste this in the chat. So BMO's is slightly lower than TD's. So that's a benefit to BMO because you want to have the lower price to sales ratio here. So TD 3.32. And then also, if we looked at the trailing price to earnings ratio for TD, it's 10.55. TD. And then as we saw before and the earlier, the BMO's price to earnings ratio was, so BMO's price to earnings ratio here was 8.07. So BMO has a lower price to sales and lower price to earnings. So that's a benefit of having BMO. It's significantly lower than TD. So BMO is likely a better investment than TD in this case. So let's continue on this here. So issues with here, what can go wrong? High leverage. So one of the problems with using price to sales ratios is that you're dividing the market value of equity by the revenues of the firm. So when a firm has borrowed substantial amounts, the market value might be trading at lower multiple of revenues. So if you pick stocks with low price to sales ratios, this might be due to a lot of debt. So they may be having high sales because of a lot of debt. And then also they may not be making any profits. So they may be having higher sales due to high debt. Also, they may have high sales, but they have low profits. So what industry would have, so what type of industry would have high sales but low profit?
Maybe they're a restricted market, for example, in pharmaceuticals, when they treat a very rare genetic, let's say, disorder, it's a very small percent of population, and it will cost a lot to treat those patients, but it will not be high profit because the population is only a tiny percent that actually struggles with a genetic disorder.
Yeah, that's an example. Yeah, that's an example where the profits could be very low. Yeah, exactly. So maybe they are providing an affordable drug to people in need, and the cost is high, so the profits are very low. That could be it. So it's affordable, cost is high, so the profits are very low. That's a good point there. And then here, dividend yields. So dividend yields, there's no correlation really. So in terms of annual return, there's really no correlation. So like with dividend yields, there is really no correlation between dividend yields and average annual return in this case. So determinants of success of passive screening. So have a long time horizon. So all of the studies quoted above look at returns over time horizons of 5 years or greater. In fact, low price to book value stocks have underperformed high price to book value stocks over shorter time periods. Choose your screens wisely. Too many screens can undercut the search for excess returns, since the screens may end up eliminating just the stocks that create the positive excess returns. So be careful of that. So if you don't think price to sales is needed, price to book is needed, price to earnings, cash flow, net income, profit margin are needed in one case, then get rid of one of them. In terms of evaluating stocks, and then be diversified. So own, so ensure that you own stocks from different industries. That's very important. So own stocks from different industries. That's very important because if one industry goes bad, you have other investments that will stay okay. So that's very important. For example, the crypto industry collapsed last year. And if you had all of your money in crypto, you could have lost all your money. So like own stock from different industries. So like for me, I own stock from railroads, banks, software, car companies. So like so it is important to own stock from different industries. Don't stick with just one. So that's very important to investing. And then watch out for taxes and transaction costs. Some of the screens may end up creating a portfolio of lower price stocks, which in turn create larger transaction costs. So accounting checks. So it's important to look at, instead of looking just at current earnings, look at normalized earnings, average earnings over a period of time, adjusted earnings, where investors devise their own measures of earnings that correct for what they see as shortcomings in conventional accounting earnings, and owners' earnings, where depreciation, amortization, and other non-cash charges are added back and capital expenditures to maintain existing assets are subtracted out. So also moat. So Warren Buffett talks about a thing called a moat very often. And it's the measure of a company's competitive advantages. So the stronger and more sustainable a company's competitive advantages are, the more difficult it becomes for others to breach the moat, and the safer it becomes for the earnings stream. So make sure that the company has a good competitive advantage. Also, margin of safety is the buffer that value investors use to protect them against risk. So looking at margin of safety is very important, and a lot of people online at different finance websites can calculate the margin of safety for you. So contrarian value investing, buying the losers. So you can do this through if, let's say, you see a company that is being unfairly treated by the market. Let's say a company's stock goes down and it was because of a non-financial reason. Like, let's say there was bad publicity for people that work for the company, let's say, or the company is having, let's say the company is having a bad, like, let's say the company is in the news and they're getting criticized for a non-financial reason, and then the stock's going down because of that. And if you find out that it's not a financial reason, like if you find out the profits for the company are going to stay high or will keep going higher, even though this bad publicity is happening for the company, you can buy the company and you'll benefit likely. Just you have to make sure that bad news about the company. So make sure that if the company is getting bad publicity and the stock is going down, make sure that none of this is going to affect the company's profits. So like if it won't, then the stock will likely go up in the long run. So that's what Warren Buffett's done. He's looked for those companies that have had bad press and then has made a fortune just investing in them when they recover, because it hasn't affected their profits. So that's very important. And then winner and loser portfolios. Since there is evidence that prices reverse themselves in the long term for entire markets, you may want to examine whether such price reversals occur in classes of stock within the market. So you may want to look at reasons why stocks go down and stocks go up. And so here they combine stocks from different portfolios. So a winner stock portfolio and a loser stock portfolio. And then you can analyze the reasons between both of them, figure out why the stocks in the loser and so in this case, they're actually checking why these good stocks are going down and why these bad stocks are going up. So in that case, you can analyze why a certain portfolio will go up, a certain portfolio will go down. So there's evidence that these loser portfolios are more likely to contain low price stocks, which generate higher transaction costs and are more likely to offer heavily skewed returns. Loser portfolios created every December earn significantly higher returns than portfolios created every June. Then the long-term horizon is needed for the loser portfolio to win out. So also another good strategy is to buy quote unquote bad companies. So if the price is right, so you may want to buy a company at a cheap price and then just hold it until it goes up. So that might be something you want to do. We'll skip a lot of this here. So yeah, these are very important factors here. In order to, you want ego, overconfidence, and bias not to get in the way. So you want to make sure you're thinking logically and without emotion. And then you need to adjust for risk. So you need to adjust based on the risk factor because risk changes over time. So monitor risk and then make changes based on that. And also review the business and figure out that if it's running efficiently, consistently, and then make changes, like potentially sell your stock if you think that it's not running the way you want it to run. And then also, yeah, just monitor how the business is doing, monitor the risk, monitor the efficiency, and monitor the judgment of the management, and also monitor the economy. See how the economy is doing, and then monitor how the company will be impacted by the economy. So those are important. And then just gonna skip a lot of this stuff here. And also you can borrow to invest, but it's very dangerous because borrowing to invest, you can go bankrupt. Like if the stock goes down, you can get a margin call, and that's basically bankruptcy. So borrowing to invest is a big risk. So I recommend not doing it because you can go bankrupt through that strategy. So I recommend not borrowing to invest. And then we'll skip a lot of this stuff, but this is available under March 9th if you want to keep going through this, but a lot of the rest isn't relevant here. But yeah, so value investing comes in many stripes. There's screens such as price to book value, price to earnings, and price to sales ratios that seem to yield excess returns over long periods. It's not clear whether these excess returns are truly abnormal returns for rewards for having a long time horizon, or just rewards for risk. And there's also contrarian value investors who take positions in companies that have done badly, and then the stock will go back up. And then activist investors who take positions in undervalued and or badly managed companies, and by virtue of their holdings to unlock the value. So those are a lot of ways to succeed in value investing. So I'll post it in the chat. Yeah, so these strategies are key for investing success. And I'll show you, I posted audiobook under our course, and I'll show you where it's located. So it's under economic documentaries. So I recommend for further investing support, go to economic documentaries under our course and go to the Intelligent Investor audiobook. So I recommend listening to this. A lot of the ideas that I talked about are from this book. It's a great book. In this audiobook, it goes through it all. So I recommend that, The Intelligent Investor by Benjamin Graham. And then there's another book that it's called, so I'll show here. So it's under economic documentaries too. And then it's called Poor Charlie's Almanac. And a lot of the ideas I just talked about are from Poor Charlie's Almanac also. So I recommend doing that. And then what I'm going to do next is I'm going to go through growth investing quick. So growth investing is another strategy, and this is under March 9th materials also. So if you want to review this, it's under the March 9th materials also. So this is another strategy you can use. So Warren Buffett uses a combination of value investing and growth investing. So he uses both strategies combined now. He used to just use value investing, but he's incorporated a lot of growth investing in also. So let's get started here. So in passive investing, history has picked a winner, but there are periods where growth outperforms value. So growth investing can be better in a lot of cases. And the good thing about growth investing is that it predicts the value of companies. Like growth investing is needed for tech companies because the growth of tech companies is not explained by value investing. So tech companies growth is not explained by value investing. However, value investing explains a lot of the growth of banks and railroads. So it just depends on the industry. Certain industries require growth investing, certain industries require value investing. So when measured against their respective indices, active growth investors seem to beat growth indices more often than active value investors beat value indices. So here, between 1981 and 1995, the average actively managed value fund outperformed the average actively managed growth fund by only 16 basis points a year. So the difference is related to active growth managers. So active growth managers, they provide a lot of value in this case. So with growth investors, they look at companies that are smaller and less followed than companies followed by value investors. So they look at companies that are not followed as much, and that's a big difference. So then that provides more arbitrage opportunities. So like growth investors follow the companies that people are not looking at usually. Therefore, there are more arbitrage opportunities. Yeah. And then valuation difficulty. Value companies are generally easier to value than growth companies. So so being a value investor, you can value companies easier, but growth investors take more of a risk. And high growth firms are often in sectors where knowledge provides an advantage to investors. So in your programs, having your subject matter knowledge in bio is very important if you're going to invest in the bio market. So that's a big advantage for you. So being a growth investor in your case, so being a growth investor in the bio market is a good path because of your subject knowledge about the market. The benefit of the growth investing is that the benefit of growth investing is that it favors subject matter experts. So like if you know a lot about an industry, like the ins and outs, you will be potentially very successful in growth investing. So that's a big benefit. Like if you're an expert in bio, then you could be a very successful growth investor in the bio industry. So that's a good, so like you could really benefit, like all of you here could really benefit with your subject matter knowledge, applying it to investing. So you could specialize in investing in bio type stocks. So that's a very good take home point there. Yeah, so I'll put this up here, then I'll share this here. So yeah, you being a growth investor, it's really about subject matter knowledge. Yeah. So the pitfalls of growth investing, there's a lot of risks of each. So the scaling factor, as companies grow, they get bigger. As they get bigger, it's more difficult to keep growing. So growing is very difficult. And then cost of growth can be good, bad, or neutral for value. It depends on how much the company pays in investments to get that growth. So the company can be growing a lot, but profits are not going up. So you want profits to go up. Growth for the sake of growth without profit growth is not beneficial for stock owners. The momentum game. So since most investors in growth stocks have given upon the uncertainty inherent in them, momentum game is likely to dominate how these stocks get priced. So the pricing gap will increase over time rather than decrease. So scaling is hard to do. It's hard to grow a company over long term. Very difficult. So value of growth. To generate growth, firms have to reinvest money in capital expenditures, R&D, acquisitions, and working capital. So this reinvestment reduces the cash flows. So the growth then becomes a net effect. So lower cash flows for higher earnings in the future. And yeah, so there's a lot of risks to growing. So these are a lot of factors you can look at to this looking at all these factors are good before investing. So this would be a good checklist in terms of investing, like what you have to check off. Good checklist before investing. So looking at all of these things, or many of them. You don't have to look at all of them. You can pick and choose which ones you think are the most important. But like cash flows are important, growth in cash flows, intrinsic multiples, book value based approaches, liquidity, corporate governance, market moods, surface stories about fundamentals. Multiples just mean price to earnings. So multiples are price to earnings, price to book, price to sales, any statistic for the company. So that's what it is. Yeah, so that's growth investing. And so we went through value and growth investing, and we got through a lot of great material for today. So I recommend go to, if you want to review that further, go to March 9th materials, and that will be under value investing and growth investing here. So I think we will close it out for today, but does anyone have any additional questions for today?
I think I'm good. That's a lot of information to soak in.
Yes, yes, exactly. I agree. I agree. So I recommend, I'll put this also under the material for today, the how the market works.
Sounds good.
And-
Thank you.
Sure. So I'll go through more of this as we go along. Like I'll cover more of it for the rest of the class. Just like I'll cover more of this in future classes, just to go deeper into some of the stuff we covered. But I posted how the market works here. So if you haven't made an account yet, I'd recommend make one and then apply some of the value investing and growth investing material we learned today to investing in companies through how the market works. And then with your subject matter knowledge, all of you could invest, you could find potential companies in pharmaceuticals and bio that you could invest in. So you could do that as a growth investing approach. So that's a potential approach. Or if you want to do pure value investing or a combination of both, it's totally up to you. All those strategies are good. Merging parts of both strategies is good too. But yeah, so that's the how the market works exercise is good for potentially applying a lot of these things. So thank you, everyone. Like I said before, I really appreciate all of you staying and appreciate all your participation and all your hard work this semester. And yeah, I really appreciate everyone being engaged, and thank you for all your hard work today. And I hope you have a good rest of your week.
Thank you. You too.
Thank you.
Thanks everyone.